let's continue from where we stopped. We've been discussing about financial functions. In the previous video, we have discussed about the two main important financial functions that is relating to the investment appraisal. So there we discussed the NPV function and the IRR function. Now we are going to looking at another important function that is called the loan amortization related functions. Basically, while you are learning in the second year under the financial management course, you have extensively discussed how to compute the loan installment of a particular loan that you may obtain, and also how to separate the interest component in a particular loan installment and how to separate the capital repayment in that particular loan installment. So this is something that you have learned and applied in a manual environment. Again, here what we are trying to do is we are going to learn how to prepare the loan amortization schedule. In that, how to compute the loan installment using the spreadsheet package, the inbuilt functions, and also how to distinguish the interest component and the capital repayment. So basically, under the loan amortization related functions, we'll be learning about three main functions. So one is for the loan installment computation, the other one is for the interest computation of a particular loan installment, and finally we'll be learning about how to compute the capital repayment component of a particular loan installment. So we'll be focusing on these three financial functions under the loan amortization. When it comes to the loan repayment schedules, there we need to show the loan installment and the capital repayment component and also the interest component. Basically, the loan amortization schedule in the sense, there we identify a particular column that is for the installment, and another column is dedicated that is to identify the interest component of that particular installment, and we may be allocating another column that is to the principal payment, or we call it the capital repayment. And together with that, we'll be identifying from the beginning the loan outstanding at the beginning of the period, and towards the end we'll be identifying loan outstanding at the end of the period. So this is basically what we call the loan amortization schedule or the loan repayment schedule. So since when it comes to the preparation of these loan schedules, we need to identify the installment and the capital repayment and also the interest payment. There we may have to make use of some of the important inbuilt functions. So more specifically, we'll be using the PMT function, that is to compute the installment of a particular loan. Similarly, in order to identify the capital repayment, we use the function called ppmt function. At the same time, in order to identify the interest payment, we can make use of the IPMT inbuilt function. So these are some of the functions that is there in the spreadsheet package what you use to facilitate you with the computation of the installment, the capital repayment, and the interest payment. So this would be particularly useful when preparing the loan repayment schedules. First, we'll focus on the PMT function. This calculates the payment for a loan based on constant payment and the constant interest rate. Here, the PMT function basically helps you to calculate the loan installment. And when it comes to this loan installment, you'll be calculating based on a particular interest rate. So it is a constant interest rate. We assume that the interest rate may not vary throughout the loan period. So that's why we are saying that the interest rate that we use is a constant interest rate. And also our loan installment is going to be constant throughout the period. We'll be paying a equal installment. We'll be settling the loan or the lease in a equal installment. In that, if we take the syntax of this PMT function, basically you need to identify 4 to 5 important informations. So just to see that, the first one, we call it the rate. You need to identify what is the interest rate of this particular loan. So that information has to be given as an input. Then you need to identify the total number of payment. It depends on whether you make the annual payment or whether you make the monthly installment. So depending on that, the total number of payment would be determined. So that is what indicated by NPR. Then we have to identify the loan amount. We call it the principal amount. So it is symbolized by the PV, the present value. So that is where we include the loan amount. Then we have another option that is called future value, FV. The future value or a cash balance you want to attain after the last payment is made. If FV is omitted, it is assumed to be 0. That is, the future value of a loan is 0. You know, in some cases, when we go for this loan installment, all what we expect is to settle this loan at the end of the loan period. But in some cases, we might find that at the end of the settlement of the loan, the borrower expect that there must be some kind of saving should be there in his loan account. So he would wish to have a kind of saving simultaneously. So in one hand, he'll be settling the loan in installment. At the same time, he is accumulating a particular fund that he can get at the end of the loan period. So say for an example that you may be obtaining a loan of say 500,000. Then you need to ensure that at the end of the loan period there must be a saving of 100,000 there in the loan account. So you want to simultaneously make a saving. So in that particular case, as far as the installment is concerned, you may have to pay something in addition. So if you just settle the 500,000 loan, then you will be having a particular installment, particular monthly or annual installment. But if you wish to have a saving at the same time, the installment what you may pay could be little higher compared to the previous. The simple reason is that because and in one hand you will be settling the loan, and on the other hand you are creating a fund, you are creating a saving there. So in order to make the saving and the payment of the loan installment what it comes, it could be a higher compared to the previous instance where you just want to settle the loan. So if you this is a kind of optional one, so it is not something mandatory like rate, NPV, NPR and the present value. So here if you simply ignore this, it consider the future value to be 0. Future value to be 0, that is in the sense you need not to have a kind of saving or something. And finally you have the type. Then again this is something optional, so you can ignore this, or otherwise you can specify that. The number 0 or 1 and indicates when payment are due. So if you ignore this, it is taken as 0. So it is what the function assumes, you will be making the payment at the end of the lease term. At the end of the period, you are making the loan installment. So if you take the option 1, then it assumes you will be making the payment at the beginning of the period. So it is just to distinguish whether you make the payment in advance or payment in arrears. If you take 0, it assumes that you'll be making the installment at the end of the period, but instead if you insert 1 over there, then it assumes you'll be making the payment at the beginning of each year. So that is what this type. So again, when come to the 4th and 5th items in this syntax, they are optional. So you can simply ignore that. But in some cases, it may become relevant, especially if you want to have a kind of saving. You have to have this fair value. And again, you'll be making the payment in loan installment if you are settling in advance or at the beginning of each period. You may have to take it as 1. Now we may take a particular example and try to apply this. Let's say that you obtain a particular loan today. So let's say that you're obtaining a particular loan on 1st of April 2020. And the loan amount, let's say you're obtaining 1 million. You're obtaining a 1 million loan. You have obtained 1 million loan. And so let's say the loan period, you want to settle this in 5 years time. And most importantly, let's say that you want to, the applicable interest rate is, the interest rate applicable in this loan, say 15%. And let's assume there are no future value, or that we expect to settle the loan installment at the beginning of the period. So under the normal circumstances, if you are to compute the installment, say that you want to compute a kind of annual installment, then all what you have to do, you have to take the PMT function. You can take the PMT function. So there you can specify the rate. So you have to specify the rate, and that is going to be 15%. So let's make it constant. And the NPR, so that is going to be the total number of payment. So if you are settling this in annual installment, that has to be 5. That has to be 5. Then the present value, or the loan that you have obtained, it is going to be 1 million loan. So if that is the case, you can see the loan installment comes as 298,350. So we haven't taken this future value and the type option. We haven't taken that. We have just said okay. Then if you see, this should be the loan installment. It's 298,315.55. Then let's say at the same time that you want to compute, so this is a kind of annual installment. Let's say that you want to identify a monthly installment. Let's say it's a monthly installment. So in that particular case, what you can do, again, you can take this PMT function. In that, you would take the rate, and it is 15%. But remember, this is an annual interest rate. So in this particular case, you need to convert that into a monthly interest rate. So if you are going by the monthly installment, you have to convert this into a monthly installment. So monthly interest rate. Then how do you do that? You can simply divide this by 12. If you divide it by 12, it turn around to be a monthly installment. Then the total number of payment for the loan. Here you have the period as 5. You may start with that. Then you want to convert this into monthly installment. So therefore what you have to do, you can simply multiply this by 12. So then for the 5-year period, we have 60 months. We have 60 months and we have got that particular option. Then the present value, it remains the same. So it's going to be 1 million. It's going to be 1 million. So here we have the monthly installment. It comes as 23,789.93, the monthly installment, whereas the annual installment, it is going to be 298,315.51. So these are all rupees. You can format the currency. So if needed, so again, if you want to convert that into local currency, you can make it LKR. So here we have LKR. You can take that option. So here also you can do the same. The more number formats, that you can get the LKR. Right. Now let's see that you want to say at the end of this loan term, you want to have a kind of saving in the account. Let's say that you want to have a saving of, say, 100,000 in the account. 100,000 in the account. Once you settle this loan at the end of the loan period, in your account, in your loan account, you expect to see rupees 1 million as a saving. So it's a good practice. At the end of the loan, you are having a kind of saving. So simultaneously, you have make a saving. So if that is the case, what do you expect the loan installment to be? Would it be higher than this, or would it be lower than the current installment? Definitely, it has to be something higher than this. That is simply because it need to compensate for this saving. It need to compensate for this saving. It is not just the loan repayment, but also at the same time you want to make a saving. So therefore, you should experience the loan installment to be higher than this. So you can simply copy the formula that you get over there. Then you can do the changes that you want. So the rate is there, the present value. So there, you haven't made it, sorry. cancel it. So here I haven't made the loan installment constant. So if you have it, you can simply copy the same information and paste it, and thereafter we can do the modification. So here we have the rate same, the number it's same, the present value, so everything is exactly the same. But the only new thing, the future value comes in. In this particular case, you have to identify this future value. So I make it constant. Then see what happens. It is 313,147. So as we expected, as we predicted, the annual installment had become higher than the previous. That is to compensate the saving that you expect to make. So similarly, if you do this for the monthly installment, you can expect something similar to this. So if you get the fair value, so all the other information are exactly same, so the fair value is going to be 100,000. So in that particular case, you can see if you go by the monthly installment, it is little higher than the previous, and that is just to compensate the saving that you expect to have at the end of the loan period. So this is what the basic aspects that you expect to know with respect to the loan installment computation. We have calculated the annual installment as well as the monthly installment. Now let's go back to the lecture and let's see the ppmt function, the second function that we expect to discuss. Here the ppmt function, it returns the payment of the principal for a given period for an investment based on periodic constant payment and a constant interest rate. So simply putting, here what it does, the ppmt function, it helps you to identify the capital repayment of a particular installment. Here you are planning for annual installment or a monthly installment. When you take this installment, this ppmt function will help you to identify the capital repayment of a particular loan, the capital repayment component. Throughout the loan period, so from installment to installment, the capital repayment varies. So if you develop a loan repayment schedule, there you would witness that the principal component of each of these loan installment would vary over time. So in fact, we'll be working out some question, and there you can witness this instance. From installment to installment, the capital repayment varies. Generally, when you take a particular loan, at the initial stage of the loan or in the first couple of installment, you would see there would be a less capital repayment compared to the interest. Or in other words, when you take the loan installment at the beginning of the loan period, you would witness that the interest component would be greater than the principal repayment. However, towards the latter part, towards the end of the loan, you may witness it is other way around, where the principal or the capital repayment become the greatest, while the interest payment that tend to be less. So in other words, when you obtain a loan from a bank or a financial institute, what they basically do, they want to recover the interest first. So that is the natural tendency. They may try to recover the installment first, interest first, and then they look for the capital. So that is the simple reasoning behind this. So you would witness when we are working out the question. So when come to this PMT function, again all the information that you had witnessed earlier in the PMT function is there. So here it should be the ppmt, sorry, should be the ppmt function. So all the things that you witness in the PMT function is here. That is in the sense you need to have the rate, the NPR, the loan period, the present value. So if applicable, the future value and the type. But here one information varies, and that information is going to be the PER. So that is simply the period. So that is the period. So when you take a particular loan, so it starts from the first installment to the last installment it goes. So in a typical loan repayment schedule, you would witness that it starts with 1 and it may go up until the last installment. So therefore the PER, it represents the period and it varies. So must be in the range 1 to NPR, 1 to the final period. So let's say it is 5, the loan period, it goes from 1 to 5. So that's why it says 1 to NPR. So it is 1 to 60. You want to settle them in 60 months. So it goes from 1 to 60, right? So that's how it works. Then let's go to the question what we've been discussing, and we may try to construct a loan repayment schedule. So let's try to construct a loan repayment schedule there. Schedule. So in a non-repayment schedule, most importantly, you need to have the period. So let's say that it is from, on the annual basis we may develop. So we have obtained a loan for a period of 5 years. So therefore, you can take it like 5 years. So it is 5 years. And then most importantly, the loan at the beginning of the period, or I would say balance at the beginning of the period. Balance at the beginning of the period. Balance outstanding, even you can say, since it's a loan, balance outstanding at the beginning of the period. Then you can take the loan installment. Loan installment can be taken, and there you can identify the capital repayment. Right. So we may try to work the loan installment. You know how to get that. Even earlier you have taken that. The loan installment, you know that it's going to be something constant throughout the period. So you can simply take this PMT function just to show you again. So in fact we have worked this out. The rate has to be there. So get the rate, make it constant, and NPR, that's going to be the period, it's going to be 5, and the present value, and that has to be the loan amount. And let's just ignore the future value and the time. So we'll think about the basic situation. We may stick to the basic situation and we may get that, say okay, right? Here we have the loan installment 290, 360. Now I can drag it throughout the period. So as far as the loan installment is concerned, throughout the period it does not vary. It does not vary. Now we may come to the capital repayment, and we may witness that what is the function? We should get ppmt. Here it facilitates to identify the capital repayment in a particular loan installment. So you can specify the rate as usual, make it constant, and the PER. So this is the newly added information, or which is different from the PMT function. It was the PER. So when you are getting that, so you have to refer to the period. Now we are in the first period, and most importantly, make sure to keep it relative. Keep it relative, because when you drag that, it's supposed to be changed. The PER must be kept relative. While the NPR, so it is total, the loan period, it's going to be 5 years. So you can make it fixed. The present value, that is the loan amount, and that is 1 million. Say okay. Now you can see, so this is going to be the capital repayment. Capital repayment. So in this loan, you can see the first installment, this is the capital repayment. The second one, 170,000. Third one, 196. Likewise, you can see at the initial period, the capital repayment is comparatively less. However, towards the end, the capital repayment is going to be a significant portion of the loan installment. So if you especially refer to the final period, you can see that the capital repayment is 259,000, where the loan installment is 298,000. So it is nearly even 80 to 90%, 80 to 90% from the loan installment. So that is the reality. And this is how we get the loan repayment. So the only important addition, it is going to be the PER. So it must be kept relative, and it's supposed to change from period to period. Then we are moving on to the third function what we may expect to discuss, and it is called the IPMT function. So as far as this IPMT function is concerned, it basically helps to identify the interest component of a particular loan installment. So when you take loan installment, what must be the interest component of that particular loan installment? And again, this is something that we expect to change throughout the loan period. So it varies from the first installment to the last installment, and most probably at the initial periods of the loan, so you can expect a higher interest to be paid, whereas towards the end you can experience a lower interest to be paid. So the bankers and the financial institute, so they need to first recover their income, that is the interest. So they want to recover the interest or the income. So therefore they would prefer to collect the interest during the initial stage of the loan, and they may keep recovering the capital, the major portion of the capital, towards the end. So that's what you may witness. Again, the information what you are supposed to enter in this IPMT function is nothing different from the ppmt function, but it was there. Here you will have the same. So therefore we may go and apply this IPMT function. So you can take that it is about the interest of the loan. So interest. So here you can get the function, that is IPMT. IPMT function is there to serve you. So here you can get the rate, you can specify. It's going to be the 15%, nothing different. The PER, as usual, you want to keep it relative, and you may refer to the period over there. And the NPR, so that is the loan period, you may keep it constant. and the present value, that is going to be the loan, and make it constant again. Say OK. Now you can drag them down. See, this is the reality. You can see that at the beginning of the period, at the initial stage, the interest component is higher than the capital repayment. However, towards the latter part or towards the end of the loan, you can see that the interest component would be comparatively less. Comparatively less. So that is what I've been telling you. Now, in order to complete this, you can get the balance outstanding at the end of the period. Balance outstanding at the end of the period. At the end of the year, you may get the balance outstanding. So in the initial period, you can refer it. Here it comes. You get that. Then how do you calculate the balance outstanding at the end of the period? It is simply, you make it the balance at the beginning of the period, and you can deduct, since it's a minus figure, you can add the capital repayment. So then it is deducted and you may get the balance outstanding at the end of the period. And that is going to be the balance at the beginning of the next year. So you may refer that, and you can simply drag this down, double click it, and here you can ask simply to do the same. From the beginning balance, deduct the capital repayment as you specified earlier. So you can simply drag this down. Then you can witness at the end of the period, this amount outstanding had become 0. Amount outstanding had become 0. But if you wish to have a kind of saving at the end of the period, so you can decide then. So all what you have to do is you have to accommodate this future value in the formulas. So let's say that you want to have this 100,000 at the end of the period. Then what you can do, you may go to this loan installment and you can get the future value. You can get the future value there. So it is 100,000. So make it constant and say OK. See, the loan installment is comparatively high. Comparatively high. Then the capital repayment, you may have to do the same. The future value has to be specified. This is it. And the interest, you may have to do the same. Future value has to be specified. The saving that you want to have. Then you can see at the end of the loan, you are having this 100,000 in your hand. So you have settled 1 million was there, 163,000 settled, 836. Likewise, you keep settling the loan. Then at the end of the final year, you can see that it was 185,345 was outstanding. Out of that, you may take it. You would be paying the loan installment of 313,147 as usual. But in that, the capital repayment component is like 285,345. So it is clearly in excess of the amount outstanding. And then once you pay that particular loan installment, you would witness that at the end of the period, you are having 100,000 in your account. So where you can withdraw and have it as a saving. So that's how you do this. That's how you prepare the loan repayment schedule. So these are the basic aspects that you expect to know, and thereafter, so you can we may take some examples and we may try to work out the loan repayment schedules. Right, let's go to the activity. So there is activity given. It says that on 1st of July 2019, the ABC Private Limited acquired a motor vehicle under a finance lease. The following information is provided in relation to the lease. So since it is no longer the finance lease, let me remove that. Now there's no classification as such, the books of lessee, so we may remove that. Then the fair value of the motor vehicle is 5.5 million. The down payment is 1.5 million. The annual lease interest rate is 20% and the lease term is 5 years. So this would be the basic information that is given. Then you need to compute the value of the monthly lease installment. You are supposed to compute the monthly installment and also to prepare a schedule for the 5-year lease. Then you are supposed to prepare the loan repayment schedule as well. So let's try this out. You can simply copy this information. Let me take it to a separate sheet. Basic question is this. Then let me extract the inputs in this situation. In the given case, you need to identify the inputs. So here you need to identify the lease. So in fact, the fair value of the vehicle is 5.5 million. So since you make a down payment of 1.5, all what is outstanding is going to be the 5.5 million. Let's take the figures in thousands. 5.5 million minus 1.5 million. So it is all what is left is going to be 4 million. 4 million. So let's take the things in thousands, and then you can take the interest rate. You can extract that interest rate, which would be of use. Interest rate that is going to be 20% per annum, and the lease term what you had negotiated, that is to be 5 years. Then accordingly you've been asked to calculate the monthly lease installment. So if you have to fulfill that, the monthly installment, so that is going to be, you may make use of the PMT function. Let me draw from the PMT function. The rate is there, specify that. The NPR, it's a long term, lease term, specify that. Then the present value, that is 4 million. And here you need to be conscious, you've been asked to work out the monthly installment. So therefore this rate has to be converted to the monthly rate. All what you can do, all what you have to do, divide it by 12. And in order to compute, to make this lease term to the month, and that is going to be multiplied by 12. Then it turned out to be the months. The present value is there, and you can say okay. So it's like 105,000. So it is nearly 105,000. So that is going to be the monthly installment. Monthly installment. So if you want to take them in the full amount, even you can do that easily. So it's going to be exactly 105,975.53. So that is in full term. Now you need to prepare the loan repayment schedule for the 5 years. So you can take that, the loan repayment schedule. So there you have the period, then you have the lease outstanding here, lease outstanding at the beginning of the period, then you can take the loan installment or the lease installment here. Since it's lease installment is there, then you can take the capital repayment, what is there, or the principal payment, then you can take the interest, and finally the balance outstanding at the end of the period, balance outstanding at the end of the period. We can have the period from 1 to 60. You can simply drag it to take it up until 60. Then there is the loan period. Then you can take the lease installment. You can simply refer it over there and make it constant. You can simply double click and that would be taken up until the 60. So it does not change, it's a constant interest, constant installment. Then you can compute the capital repayment. It is going to be the ppmt. Using the ppmt function, you can work out the capital repayment or the principal payment. So the rate is going to be 20%, but most importantly, convert that into a monthly rate, divide by 12. The PER, that must be a reference, keep it relative as we did. Then the NPR, that's going to be the lease term, that is the number of years multiplied by 12. So there you can make it constant, and the present value, and that is 4 million, make it constant. No future value is involved, and that's the information that you may need to have for the capital repayment. You make the rate and you make the term. So the installment what you are in is specified that, and the NPR was taken and the present value. Then you can say OK, and here it comes as this much. Then you can simply double click, then it may go up until the 60th installment. Then you have to compute the interest by using the IPMT function. The IPMT function, as usual, take the rate, most importantly convert that to a monthly one. The PER is going to be the reference, keep it relative. The NPR, that's going to be multiplied by 12. The present value, that is 4, make it constant. Then you can simply take it till the end. Now you have to complete this. Start with the lease outstanding at the beginning of the period, make a reference, you can have it. Then at the end of the period, it is simply the lease outstanding at the beginning of the period plus the capital repayment. So you may simply deduct that. Since it's a minus figure, you may take it as addition. Then you have the lease outstanding at the end of the period, and you know that is the lease outstanding at the beginning of the next year. And you may make the reference, you can simply double click that, and here also you can double click, then it may span across the lease term. Then most importantly, you can see that at the end of the lease term, when you pay the last installment, that the loan outstanding or the lease outstanding should become 0. So this is how we take the loan repayment schedule in this particular point. Now, in order to look at how this capital repayment and interest would vary across the lease term, you can have a graphical representation of this. So if you have a graphical representation, you can have a clear understanding how this loan repayment or the capital repayment and the interest works throughout the loan period. Throughout the loan period, how this capital repayment and the interest behaves. So you can have a clear understanding. So in order to do that, what you can do, you can go to this insert. There you can select a suitable chart for this. So the line chart may be suitable for the situation. So then you can select a particular type which is provides a good understanding of this. So it's like this. Here you can see clearly how this interest and the capital repayment behaves. So you can see throughout the period, here from 1 to 60, throughout the period, this is how the capital repayment and the interest behaves. So it should be other way around, is that it goes like here it is taken as the minus figures, so it shows is other way around. So it's simply because that the minus figures are taking below, so that is why it shows like that. So the 20,000 is here, so therefore here you must have to read it the other way around. The capital repayment, you can see it increases from 40,000 to it starts from nearly 40,000, like 39,308, then it goes up until like 105,000. So while the interest, it starts with like 66,667 and it gradually decreases. So here the minus figures has taken other way around. If you can change it, so you can try out the formatting the aspects. So if you take these values in reverse order, sometimes it would resolve the issue. So you may take these values in reverse order, then it would be a good representation. Now you would witness a more comprehensive representation. So you can see that the capital repayment, you are starting with the lower number, it is exactly 39,310, then that gradually increases. In the final point, it is 104,238. Whereas the interest, it starts with a higher number, then that gradually decreases, then towards the end, it is having a kind of comparatively less value. It is exactly 1,737.3. Then you can identify how this capital repayment and the interest behave throughout the period. And this is the basics that you expect to learn under the loan repayment. There we have another activity for this. So I believe that it is similar in the nature, except one information, that is, at the end of the lease term, the Frederick Private Limited wants to have a saving of 200,000 in the bank. So therefore it talks about the future value, except that the rest of the information is exactly same. So therefore this must be something that you should try out. So in the class activities we may take this and you should try this out. And that is what the discussion about the loan amortization schedules.